Hi, Mike Almala, recovering CPA, back with this next lesson in financial accounting, a mercifully brief introduction. Some businesses sell products like shoe stores. Others sell services like chiropodists. Goods sold to customers are assets called inventory. Inventory measurements can be surprisingly difficult. Different inventory measurement approaches can lead to wide variations in reported profits or losses. The difference between a product's sale price and its cost is called the gross margin or gross profit. Obviously, the higher the margin, the better. The cost of the product is called cost of goods sold. We would hope that computing gross profit would involve a simple subtraction of total cost of goods sold from total sales. Alas, things turn out to be more complicated. Adding total sales generally poses no great measurement problem, but calculating the cost of goods sold is not as straightforward. The basic difficulty arises when a business does not completely sell all its goods during the accounting period. In fact, most firms finish their year with unsold inventory. Valuing the unsold year-end inventory is the primary source of complexity in figuring out the cost of goods sold. Here's an example. Janus buys and sells a silicone gel compound used in the production of cosmetic surgery implants. Assume that Janus can sell an ounce of compound for $500 that costs her $250. Let's say Janus bought and sold precisely 100 ounces of compound during the year. What is her gross profit? Now change the scenario and assume she bought 150 ounces of compound but sold only 100 ounces during the year. This means that she has 50 ounces left. What is her gross profit now? The $37,500 cost of goods sold is derived by multiplying 150 times 250. But this does not make sense because unsold product on hand at the end of the year should not be treated as an expense. Treating unsold year-end inventory as an expense violates the matching concept and common sense. Instead, we need to complicate the computation of the cost of goods sold by taking into account ending inventory as follows. Cost of goods sold will equal the beginning inventory plus purchases minus ending inventory. Now, what would Janus's cost of goods sold look like assuming she had no beginning inventory using the above formula? Now you can see that this matches our cost of goods sold figure, our original cost of goods sold figure. To arrive at the $12,500 ending inventory figure, the 50 unsold ounces was multiplied by the purchase price of $250 per ounce. In this example, all Janus purchases were made at the same price, $250 per ounce. In the real world, the per ounce cost is likely to fluctuate. Also, Janus, like many other businesses, may offer more than one type of product with fluctuating prices. In order to accurately compute the cost of goods sold, Janus has to be able to get an accurate count of unsold inventory on hand, and she also has to assign the correct price to the products. In assigning a cost to unsold inventory, you would hope to use the actual cost. This is not as easy as you would think. For Janus to use the actual cost paid, she must be able to identify the cost associated with batches of product on hand at the end of the period. However, these batches might come from more than one purchase, each with a different purchase price. Assume Janus stores her purchases in one big tank. Assume that purchase prices fluctuated during the year. Because she keeps her product in one tank, she cannot physically tell which batches go with which costs. She can certainly weigh the amount of product she has on hand at the end of the year, but how does she know the unit price to assign to her ending inventory? In order to assign a cost to her ending inventory, Janus will have to make assumptions about the flow of product in and out of the tank. One plausible flow assumption is called FIFO, standing for first in, first out. Under this assumption, ending inventory is associated with costs from the most recent deliveries. An alternative assumption is called LIFO, standing for last in, first out. Under this flow assumption, ending inventory is associated with the oldest purchase prices. Alternatively, Janus might avoid making any flow assumptions by simply using a weighted average cost of deliveries to value ending inventory. You may think the choice of flow assumptions in assigning cost to ending inventory is a relatively minor matter. However, the choice of inventory flow assumptions can dramatically affect reported cost of goods sold, gross profit, and net income. Assume that Janus received 4 shipments during the year as follows. If she has 50 ounces of compound unsold at the end of the year, different flow assumptions will yield different ending inventory figures. If she uses a FIFO approach, she will assume that the remaining inventory comes from the 2 most recent purchases. If she uses a LIFO approach, she will assume that the remaining inventory derives from the oldest 2 purchases. Alternatively, Janice could use a weighted average approach as follows. You can see that the 3 different approaches lead to a range of $7,900 to $17,000 in ending inventory value. The following table shows the variation in computed gross profit. Because the example uses relatively small dollar amounts, the dollar variation in gross profits under different flow assumptions may not seem extreme. The gross profit percentage, however, reveal a more startling set of differences. Gross profit is reported as 59% of sales using FIFO, but only 41% of sales using LIFO. If you're looking at a company with millions in sales, you can see just how dramatic an impact inventory flow assumptions can have on reported earnings. Does GAAP stipulate the specific flow assumptions a business has to use? Actually, GAAP allows a business to use any flow assumption it chooses as long as it does so on a consistent basis. This means that flow assumptions used in one year must be the same as used in the next year. Allowing different inventory flow assumptions means that 2 businesses with identical operating results can report dramatically different amounts of profit. Fortunately, GAAP does require that firms disclose in their financial statements the inventory flow assumptions used in computing cost of goods sold. Now, ending inventory is recorded and reported at its cost. This means that inventory reported on a balance sheet does not reflect its retail value. Now, there is one circumstance in which GAAP requires a firm to adjust its inventory to its fair market value. GAAP requires that inventory must be carried on the books and reflected on the balance sheet at the lower of cost or market value. This means that inventory cannot be adjusted up to fair market value, but must be adjusted down when its fair market value declines below its cost. Now, inventory offers a big opportunity for management to airbrush their financial statements. If they want gross profits and hence operating profits to appear higher, the value of ending inventory simply needs to be overstated. And there are many ways this can be done. The ending inventory value can be fudged upward by overstating the amount of inventory on hand. Unit costs assigned to ending inventory can be inflated as well. Or obsolete or damaged inventory can be included in the ending inventory count. Sometimes, for income tax purposes, management may want to show lower gross and operating profits. Ending inventory measurements can be used for this purpose as well. In this situation, management seeks to undercount and undervalue ending inventory. Click here for the next lesson.